Everyone, and welcome back to The Explainer. If you're looking to cut through the noise and get a structured, no-nonsense breakdown of the markets right before the bell, you are in the exact right place. Today, we've got a seriously dense set of pre-market data to unpack from the August 25th Global Risk and Volatility Report. We're going to be looking at the whole shebang, from international sanctions and trade tariffs all the way down to some very specific domestic institutional flows and options data. The goal? To take this giant mountain of data and turn it into a clear, actionable map for your trading day. Let's get into it.
So, right off the bat, this is the defining question for today's session. As we dig into the numbers, a pretty fascinating narrative starts to emerge. We're essentially looking at a classic scenario of a global storm meeting what looks like an Indian safe harbor. Overseas, the macro environment is dealing with stumbling tech giants and some fresh geopolitical friction. But here at home, the institutional money is telling a slightly different story. So let's start at the very top of the funnel, look at those global wins, and then zoom right into our local market levels.
Kicking things off with Section 1, Global Pressures and Crude Oil. Because before we can even look at our own indices, we really have to check the global geopolitical weather.
Now, the very first major risk factor hitting the wires today comes straight from the geopolitical arena. We're looking at a direct quote here regarding U.S. foreign policy, the U.S. announcing an expansion of sanctions aimed at cutting off Iran's economic lifeline. Now, viewing this purely objectively and setting politics aside, from a market perspective, this is a massive injection of uncertainty into the global system. And it's especially critical when we start thinking about energy supply chains in the Middle East, which means naturally we've got to look at the energy markets.
And that brings us to this incredibly important number, $92.52. That is your current price per barrel for Brent crude. Now, context is everything with this one. It's actually cooled off from roughly $94.50 just a day earlier, which, might sound like a bit of relief, but the pre-market data shows it's already trading higher in the morning session. This is an absolutely crucial metric to watch today, because rising crude prices can be a direct headwind for import-heavy economies like ours, instantly putting pressure on margins and inflation expectations.
Moving down the funnel to Section 2, U.S. markets and trade tariffs. Let's see how Wall Street and North American trade policies are setting the stage for us.
Over on the trade front, the U.S. just announced a massive 50% tariff increase, specifically targeting Canadian autos and auto parts. Again, just looking at the facts neutrally, anytime you see a sudden, steep tariff hike like this, it introduces a brand new geopolitical trade risk component into the global economy. It literally disrupts supply chains and changes corporate profitability models overnight. That kind of sudden friction, it easily makes global investors nervous and pushes them toward a more defensive shift in their portfolios.
And honestly, you can actually see that exact nervousness reflected in the U.S. market performance. If we compare the broader market to the tech sector, it's night and day. The general U.S. markets ended Monday's session kind of in the mix, pretty flat and directionless, really. But man, if you look at semiconductor and AI-related stocks, they were hit hard. Market darling NVIDIA actually fell right ahead of its highly anticipated earnings report. So that stumbling in global tech is definitely acting as a major psychological weight on the broader markets this morning.
All right, let's pivot over to Section 3, big money and institutional flows. Let's see exactly how the Indian market is responding to all this mounting global pressure.
So when we look at our FIIs and DIIs, the foreign and domestic institutional investors that represent the big money driving the market, their behavior in the face of these global headwinds is super interesting.
Just look at the sheer volume of cash acting as a safe harbor against those global storms. It's staggering. In the cash market, both foreign and domestic institutions were heavy net buyers on Monday. FIIs pumped in over 2,493 crore, and DIIs were right there with them, adding more than 2,124 crore rupees. This synchronized buying is literally a massive vote of confidence in the domestic market. It's providing a really strong counterbalance to that weakness we saw in global tech and those rising geopolitical trade fears.
Which brings us to Section 4, Nifty options and pivot levels. We are stepping away from the macro data and zooming right down to the micro levels to build out your trading map for the day.
Now, despite that huge institutional buying we just looked at, the global storm is still going to make its presence known right out of the gate. The GIFT Nifty is clearly pointing to a gap-down opening of around 40 points, so the market is basically going to open on the defensive, reacting to that overseas weakness and the trade tariff headlines before our domestic bulls even get a chance to step up.
So to figure out where the market might actually find its footing after that initial gap down, we have to look straight at the open interest. These outstanding derivative contracts are basically drawing the battle lines for today's session. And the most crucial point right now is how traders are positioning themselves heading into this August series expiry. The Nifty spot closed at 24,219, right?
Looking just below that, we have massive put open interest, acting as an anchor at both 24,200 and 24,000. Traders are essentially betting the market won't drop below those lines. But then, looking above, we have some decent call open interest resistance sitting at 24,300 and 24,500. So traders have firmly locked in these boundaries, defining the exact battlefield for today.
And because we're squeezed between these boundaries, identifying today's pivot level is absolutely essential. This is the intraday tug-of-war line, folks. Whoever controls this specific level is going to dictate the momentum for the entire session. And honestly, this brilliantly illustrates exactly where that fight is going down today, the 24,200 anchor. With the spot close at 24,219 and that 40-point gap down we're expecting, the market is going to open up directly challenging this crucial level. 24,200 stands out as the ultimate tug-of-war zone. If buyers step in, fueled by all that institutional cash we talked about, it holds. But if the global pressure wins out, it breaks.
But what happens if the bulls grab the wheel early? Well, the data gives us a super clear if-then scenario here. Step 1, we would need to see a sustained breakout above the immediate resistance band, so right around 24,250 to 24,275. If that happens, Step 2 triggers, which is a massive short covering rally. All those sellers who bet against the market, they'll be forced to buy back their positions, which could violently push the Nifty straight up toward that 24,380 to 24,400 zone.
All right, finally, let's wrap up our explainer with Section 5, Volatility and Market Opening. We need a quick pulse check on the market's overall anxiety levels heading into this setup.
To get a read on that underlying anxiety, we obviously check the India VX. It's our primary fear barometer, and we use it to see if traders are aggressively buying protection before the bell even rings.
And yeah, the data absolutely shows the tension is rising. The India VIX registered a positive uptick of nearly 3% on Monday, settling right at 11.52. This is a direct reflection of the anxiety brewing ahead of the August expiry, plus all those compounding global uncertainties we just walked through, the Iranian sanctions, the US-Canada tariffs, and that global tech sector weakness.
Which brings us to the ultimate question to leave you with before the bell rings today. We've got strong institutional money backing the domestic market, but it's fighting head-to-head against international trade tensions, rising crude oil, and weak global tech. The battle lines are drawn perfectly at those open interest levels. So, with global storms brewing and expiry looming, will that 24,200 anchor hold today? Keep your eyes glued to that pivot level and trade safe out there. Thanks so much for tuning into today's explainer, and we'll see you next time.